format today is going to be, we're going to have two short 5-minute presentations followed by a 50-minute Q&A discussion. And then some of us will break out into 3 workshops, which is a chance to meet in smaller and more interactive groups to discuss stuff. Please do give us your feedback on this. As you can tell, we're digital novices and we're just on a journey, and we want to know really what you think. And so please fill in the online survey, which you will find sent to you shortly. The panel today is a very strong one. We've got Angelika Schöckling, she's Senior Partner at Antin, the big private equity infrastructure player. And she's on the board of Inicia, large French psychiatry group, Almaviva, a big French hospital group, and also of Amadis, which is a German and Belgian lab group. Secondly, we're joined by Stephen Dyson, a partner at Apax Partners, who is on the board of Unilabs, the pan-EMEA and now more international, actually, lab group, and also played a very large role at Capio, the hospital group, which was eventually sold to Ramsay. We're also joined by two guys from Rothschild, Hedley Goldberg, who heads up the investment banking arm of Rothschild's in healthcare services, and Helier Drager-Smith, who is a debt guru. And debt, of course, at this time of COVID is a subject which is uppermost in all our minds. I wanted to just start by talking about what we were seeing as the impact of COVID on the sector. And this is based very much on the work we've been doing on HPI intelligence, where we've been looking at subsectors across countries. So we're now looking at 16 subsectors across up to 22 countries, across EMEA, Saudi Arabia, South Africa. And just to give you a brief overview, these give you a very clear picture of the for-profit sector at a subsector level. Here's the French hospital market, for example, which, as you can see, post-COVID, we think will shrink by between 1% and 5% this year. And it also gives you, for example, here you've got the market share data on the major players in the market. And then there's a lot of research beneath this, text which looks at NCO rates and government policy and how that will impact on private hospitals in France. So let's start by just looking at what the impacts of COVID-19 has been in the lockdown quarter on activity revenue, by which I mean this is the real impact on activity before governments start to ameliorate it. There are basically 2 things, I think, which explain the impact of COVID-19 on healthcare service companies. The first is whether it's elective or non-elective, with dialysis at one end barely affected and something like cosmetic surgery at the other end, almost seen almost a complete absence of custom over the period. And secondly, it's also a reflection really of how wealthy your country is. And it's very clear that the state aid in Western Europe is much higher than that in Central and Eastern Europe. And if you go to emerging markets, there's basically no support at all in many of these countries. So what does all this mean in terms of, so if you look at this, you can see dialysis 100%, nursing homes, we think at about 90%. As occupancy rates drop and people aren't replaced. That will depend very much on the country. Some countries have got much higher replenishment rates than that. And the private pay sector, which is normally seen as the darling of the sector, particularly in countries like the UK, is probably suffering worse, because for them it is more a question of choice whether you go into a nursing home or not. We then have non-elective hospitals in Germany. These are the hospitals which are part of the German hospital network and are treated as if they were public hospitals, and take A&E, for example, and will be handling COVID. And they've seen a fall of about half in their revenue as they've lost the elective component. Labs across Europe, we think, are generally down to about half revenue as they lose the elective aspect of it. And imaging, worse hit. The 20% is possibly a bit tough and nasty. It's probably slightly higher than that. And labs and imaging companies which are doing outsourced contracts, of course, the public sector, will be less affected than this. And finally, we've got elective procedures which have been really badly hit. So what does this mean in terms of, if I look then at the impact on of this in terms of the sectors over the course of the whole of 2020 in terms of revenue, if you have factor back in government support that they'll be getting. Here again, you've got dialysis at 100%. Nursing homes, we think is about 95 to 97%. Statutory insurance hospitals, the German model essentially, and French hospitals backed by large amounts of state aid, we think are around 95%. And then you've got a group of in-between hospitals, if you like, in countries like Sweden, who do a mix of stuff at about 90%. We've then got labs, which we think will achieve about 85% of their normal revenue, and hospitals in duplicative markets, in other words, in the elective sector, at about 75%. And we think imaging might be around 75% as well. And then again, operators which are just doing elective procedures are way down there. So how does this relate to emerging markets? We talked to the IFC, who are the largest investor in healthcare services globally in emerging markets, and also to CDC, the British Development Bank, which is also a really major investor. They both say that they think it's at least as bad in emerging markets, and they give three reasons for that. First, they say that lockdown has been often more severe in these countries. Secondly, they say there's very little government help. And thirdly, they are saying really that there are certain business models like healthcare tourism, which are very important in emerging markets, which have really been devastated. So just to end then, two further points. Of course, a lot of emerging market sectors are very high growth. So if you look at Russian nursing homes, we think there the growth rate might drop from 25% to 12%. So it's not all that bad if you're in emerging markets and you're in those kind of areas. Finally, to end on telehealth, here we did a survey recently of 100 operators, and the telehealth players were saying, broadly speaking, that their sales had doubled or more than doubled during the COVID period, and that they were up a lot more than that in terms of units as opposed to revenue. And it was also very striking that all the other operators who were really struggling and hit by COVID badly, 40% of them, one of their major responses is to invest more in digital health and telehealth. So I found that very interesting. So Helier, I'll now hand over to you to look at the debt markets and how they feel about the sector. Thanks very much.
Thank you, Max, and good afternoon and good morning, everyone, wherever you are. Max has asked me to just give a bit of a summary on where the relevant debt markets are right now, and where possible to comment specifically on how that applies to healthcare companies. We're still relatively early in the stages of this crisis being absorbed, particularly by more leveraged debt markets. So some of the comments I'm making are necessarily a bit more general, but I'll be specific to healthcare where I can. So starting off with how investors are thinking about businesses across all sectors and their willingness to advance additional money to them and the terms on which they'll do so, are really focused, as you might expect, on the business's individual ability to articulate how their business will survive, adapt, and be able to operate as profitably in the post-COVID social distancing economy. And what I can say from some healthcare transactions I'll talk about in a few minutes, and a lot of our clients in the sector, is that relatively, although a diverse sector, healthcare is one of the most favoured by debt markets, investors and banks, as one able to respond to COVID in a way that continues to make sense. I'll start talking about investment grade markets, as I know that they are relevant to a lot of people on the line. Really, investors in investment grade, as everyone knows, fall into the bank market and the bond market. The bond market has been going very well, reopened about 4 weeks after the beginning of the crisis. It's now currently very active across euros, sterling and dollar markets. Companies are paying a pricing premium versus what they would have been paying before COVID. For the very largest, best, well-liked companies, that can be as low as 15 or 20 basis points. For those that are sort of towards the crossover end, low end of investment grade, nearly leveraged, that can be higher, around 75 basis points. But within that range, we're generally finding healthcare borrowers being more favourably treated. And I'll pick out one transaction as an example, very recent transaction. Yesterday, a deal was printed by Fresenius, which is a triple B, therefore relatively low rated for an investment grade company. I'm sure most of you know the business, dialysis services and products. They printed €1.25 billion of new bonds, and they printed them at between 35 and 40 basis points premium to what they had been doing previously. So, well inside the high end of what companies in other sectors are seeing with that sort of rating. Talking about the bank market now, generally banks have been supportive. There has been a bit of a sense, I think, in the banking sector that this is an opportunity for them to demonstrate that they're part of the solution to this crisis after having been felt to be part of the problem last time. So where covenants have needed to be reset in the investment grade world, generally they have been reset. And where companies have required additional liquidity or rescheduling of maturities, that has generally been looked on favourably by banks. So there has been, I think, some pressure to first investigate the ability to access the various government-backed schemes in particular countries. But after those options have been exhausted, most banks have been willing to continue to support existing borrowers with additional liquidity. This is all subject to the same sort of pricing premium as I was talking about in the bond market. Moving on to leverage markets, which I know are very relevant to a lot of people on the line. And again, so talking through the different investor constituencies. Firstly, the bond markets are a bit more of a mixed picture than we're seeing in investment grade. In the US, the bond market is wide open. In Europe, it's a bit weaker, although this last week or last week was the most active week in the European non-investment grade bond markets since mid-February. We even saw our first-time issuer, a company called Rubis Terminals. That company is an oil storage company, so it could be argued as one of those in the right place at the right time. But we have seen a very large healthcare issue from SynLab. Again, a lab testing business could be called an example of the right company in the right place at the right time. But they did a floating rate note bond issue, which was upsized from 400 million euros to 850 million euros in market. Was fantastically well received by investors. And the company was paying around 100 basis points premium to where it had paid to borrow equivalent money in the past. In the bank market, it's a slightly different picture to investment grade in that it has been proving much more difficult, I think, for leveraged borrowers to access new liquidity from their existing banks. And so therefore, where more leveraged companies need access to capital, they've either gone to the bond market if they can, or they've needed to come up with something a bit more bespoke. And we're advising a number of companies on their options around doing that, either finding an ability to put some super senior debt into their existing structure, or through structuring something that's bespoke and fits into the company's particular documentation and financing framework. Or if neither of those options work, then companies have been having to consider additional equity. The final constituency I'll talk about is the credit fund market. I know a lot of companies in the sector, and I'm sure some of the people on the line are funded by the credit funds. And by and large, we've seen good behaviour from credit funds who, as a sector, by and large, have been marketing themselves to borrowers as a real replacement for bank capital, relationship focused, long-term focused, and with you in a crisis. By and large, we and our clients have found them willing to act a bit like banks, resetting covenants where that's necessary, not being opportunistic about the terms on which they do so, and a bit advancing additional liquidity to companies who need it, although on significantly more expensive pricing than they would have done. So that's it. That's quite a quick canter through where the debt markets are currently, hopefully enough relevant to the healthcare sector to frame the rest of the conversation around M&A and opportunities.
Well, thanks very much, Hedley, for that. That was very useful. So as we go through this session, if people can ask questions on the chat box on the side there. We're particularly keen to have questions on debt and on how people see that. But generally questions, if you ask questions there, we will pick it up and go through with that. So just in general terms, Helia, you're saying that this time around is very different from 2008 in terms of the speed of response, I guess, aren't you?
Yes, I think that's right. In that because this crisis, hasn't started in the financial markets, I think banks have been much more able to get their arms around it more quickly. And as I say, I think some banks have been finding the opportunity to be seen as part of the solution this time around.
Right. Okay, fine. Okay, so, well, it's good to take questions straight away. So I'd like to invite Renan Baruch from Stone Pine Capital to come and join us on the stage. So his question really is, what verticals within healthcare will be most ripe for investment during and immediately after COVID-19? So immediately after and now, which are the best ones to invest in? Who would like to tackle that? Stephen, shall I throw you in at the deep end? What's your feeling about that?
It's a very topical question, as I think those of us in the investing side try and work out how do you invest just straight coming out of the COVID crisis. Assuming we are coming out of the COVID crisis, because I think we're still at the very early phases of that, and it's very hard to know whether this is the beginning of the end of the crisis or just the end of the first wave. So I think you have to be pretty cautious about where to invest, and and I think that the way I would look at it, or certainly the way we're looking at it, is a little bit of a barbell approach. So there are some, as Max discussed at the beginning, there are some companies and some subsectors which have been relatively unaffected or will bounce back relatively quickly, and you can be relatively confident that they're going to get through this relatively easily. Whether that's the dialysis sector or whether that's I think even the lab sector is bouncing back pretty quickly, as you would imagine. And that's sort of one type of investment you can do. Now, I think there's another type of investment you can consider, which is basically to providing capital to help the much more affected sectors, which might be ones on the elective surgery side. And dental has been very badly impacted by dentistry being closed. Where you find companies which are really struggling, and where you're using your capital as a primary capital source rather than a secondary capital source to help them, through. And if you can get to a point where you say, look, I think this is, I can give them enough money to be sure they can keep going for another 18, 24 months, and you can be very confident that you're going to see to the other side of this, and the fundamentals in the long run are good. I think that's another good use of capital, and can also be good, investment opportunities. I think to buy something today 100% where it's very depressed and you don't really know how much capital it's going to need to get through to the other side of this, I think is very challenging at this point. So, as I say, I look at this a little bit in a little bit of a barbell approach. So
are you saying that you would be more inclined to go in as a minority investor on a rescue of sorts with other private equity investors? So has the industry changed a bit in the sense that it's much more about people clubbing together to invest rather than going in as a majority investor, Stephen?
I think whether you're a majority or a minority depends in some ways on the amount of capital the company needs to versus the size of the amount of money that the investor would look to put in. So I don't think it's necessarily clubbing together or not. I think it's a little bit about saying, can we be a source of capital? It's really, Max, is the difference between being primary capital, in other words, putting money on the balance sheet to help a company through through the crisis. The other one is actually buying the company, i.e., that your money is going to buy out the shareholders of the existing company. So, I think it's probably that's how I see the distinction. And the first, the most obvious one of the former is which you see a lot of in the US is PIPE transactions. Private investments into the public stock market. I think everyone was very excited that this was going to be a big opportunity. It's a bit more difficult in Europe, but still possible. But since the public equity markets and debt markets in some ways, but particularly equity markets have reopen so strongly, I think the need, public companies can secure capital, public companies can secure capital relatively easily in the public markets. You've seen lots and lots of rights issues going through, and so I think that if you'd have asked people a month ago, I think they would have thought there was a big opportunity for investors like ourselves to be helping with fresh capital for public companies. Now, obviously, it's a lot less disclosed and discussed is around whether there are these types of opportunities for private companies, and I think we'll have to see whether when they spring up over the next 3-6 months as companies, how long this goes on for and what the state of people's balance sheets are coming out of this in the next 3 to 6 months. But I think they're two, to my mind, they're two very different types of opportunities. But both, I think, can be very interesting.
Right. And Anissa, how about you? How do you see it? Where do you think the opportunities are at the moment?
So, I think I'd be looking at the world slightly differently. And when I look at our portfolio companies in the healthcare sector, we've only invested into non-elective type of businesses, which means those are the businesses that either haven't stopped or that are picking up very quickly again. And we've seen that quite closely both in our psychiatric business, which kind of kept very high occupancy rates, as well as in our labs business, which is actually much more performing than what has been seen on your graphs, but that might be a function of country. And then you have a third part, I guess, of the non-elective businesses, which are those that are basically backed by governments, such as hospitals where governments have asked private hospital operators to free them up to allow for COVID patients, but they are reimbursing them on a lump sum sort of payment in most jurisdictions. Now, having said all that, I think we're getting out of this crisis. I mean, the COVID new infection numbers in Europe, at least, are very reassuring. We're heading in the summer. People are back busy on the streets, at least in Paris, as well as in France and in Germany, and I'm sure the UK is soon to follow in a few weeks. So that, to my mind, rather suggests the question, you've had COVID, okay, fine, and you'll have a pandemic every, 20, 50, 100 years. But are we going to be heading into recession? And what does that mean? And what sorts of companies would you want to invest into if we are indeed heading into a recession?
Yes. Healthcare service companies.
Healthcare, but maybe not those linked to consumer spending.
Yes, I suppose there are opportunities to consolidate at the moment, aren't there? I mean, I'm told that in Germany there's still a lot of M&A transactions taking place. So I guess now is a good time if you're a big consolidator, isn't it? And you've got your targets lined up.
I think so. If you look at across sectors, you will find that telecom infrastructure and healthcare have been quite resilient overall. So in my opinion, healthcare remains a very attractive, investing theme. And then you need to really go by country, because you will have seen within your statistics, there were huge variances, and you alluded to this, between countries. And you need to know if you're more closely tied to consumer spend and I call it aesthetic surgery, or if you're more into, stuff that is really necessary and can be postponed by a week or 2 or 3, but not for eternity.
Yes. And have you seen a huge increase in people wanting money? I mean, people approaching you and saying, we're looking for investors, or not really?
I mean, my feeling is that the market, people have been, in lockdown, right? And whilst, it's easy to do deals that are, relatively easy. If you've read the management teams, if you've been out, if you've seen the people, but starting a new transaction, in particular one where mistakes without having a real physical interaction with the management teams is difficult. The debt markets, I guess, up to last week have been more or less closed. So it has been difficult to do a transaction during lockdown, with the exception of those that have already been, more advanced, and where that could stay in place. But I would expect activity to pick back up now. Having said that, I would guess that Hedley would have a much better view on, upcoming M&A activity than, I may have.
Well, let's go to Hedley. Hedley, what's your view on this? I mean, are you seeing sectors opening up, or what's the sectors the most attractive?
I don't think a huge amount has really changed necessarily. I think Angelica's point is entirely right about, I think there will be, nervousness about, things which are in healthcare, which are very discretionary. You pointed to cosmetic surgery, Max, which you imagine might take a little while to come back, especially as people aren't outdoors as much as they were. But everything else, if you look at healthcare, I'll put it into maybe three buckets. There's stuff which is trading through, sometimes at a lot better than in the pre-COVID world. So anything in pharma, generally, regardless of whether it's got anything to do with COVID, talking to clients, they're probably up 20% year on year, a lot of them. Anything to do with vitamins, OTC, a lot of sort of worried well sitting at home ordering pills. I was speaking to a client which is a medtech distributor, which is roughly doing 10 times its normal volumes because it's distributing PPE. I think then you've got the second category of stuff which is impacted and which will bounce back, and it may be a sort of V-shaped bounce back or a more U-shaped bounce back, depending on, you might imagine something like eye surgery will come back in a V. Dentistry might be a bit more of a U, even though anecdotally, actually talking to countries where dentists are now open, they're telling me it has come back actually extremely quickly. And I'd say most of healthcare fits within those two buckets, and therefore, in a world where private equity dry powder is considerably more than it was last year, everybody's had a natural holiday for the reasons Angelica said, and says that you haven't been able to do deals. I think there's going to be huge pressure to do deals come the end of the year, and nobody's going to be investing in retail. A lot of investing in anything to do with non-discretionary consumer stuff, I think, will be down, which I think will then drive funds towards healthcare. So I don't see any part of broader healthcare which is not going to attract interest. The big healthcare services, the big caveat to that is, are the debt markets going to be there? But again, following what Helia said, I think everybody expects them to be to a new normal, at least certainly by September. So I think Q4 will be busy. I think where you are seeing what you will see in Q4, however, is largely processes which we're aiming to launch at some point in Q1 and were delayed, but you've got all your VDD done, etc., or you're in the middle of a process. We were in the middle of 4 or 5 processes where it just hit the pause button. I think that's what will happen in Q4. I think if you hadn't started, I think most people will probably wait till Q1, Q2 next year.
So you're really saying you think it's going to open up fairly fast and fairly strongly, really? And
yeah, I think going back to Angelica's point, I think the logistical challenge is going to be the significant one. I don't think people are generally ready to invest in businesses where they've not met the management face to face, seen the facilities, etc., etc. And so I think it means travel needs to be back, because, as everybody's coming from all places to these meetings, and people have to be able to have meetings, albeit socially distanced. But we'll see.
Let's go on to the next question then, and that's really, I see this one here for you, Helier. Are there any examples of borrowers asking for debt service moratorium, claiming COVID as the major reason? Yes. Yes, I imagine there are many.
It's a great question. So I think I'm interpreting vis majeure as meaning force majeure.
Yes.
In sort of technical legal term. Borrowers who need an interest holiday or a repayment holiday are clearly pointing to the COVID crisis as being the reason why. Certainly under English and New York law documents that I'm familiar with, there wouldn't be an automatic right to suspend interest because of force majeure, and the normal contractual provisions of the consequences of not paying interest or principal when due would apply. That said, where borrowers can't afford to pay, clearly there's a negotiation which needs to be had with the creditors. That is the same in this environment as it would be in any other environment, except, as implicit in the question, there are more companies right now who are needing to ask for that than you would usually expect. But no, there aren't examples of companies successfully using force majeure as an ability to shield themselves from needing to pay interest. But of course, we are aware of situations where companies can't pay and are having to engage in restructuring negotiations with their creditors as a consequence.
Do you think we're going to go through an inflated bubble period, Headley? Do you think we're going to actually end up? This is a question here from Snake Demko at Etna, saying, "Are we going to end up with a bubble where lots of people want to invest and there aren't enough investments?"
I can certainly see that there will be a distinction drawn in the market, between the assets which have, traded extremely well through COVID, have shown them to be A, resilient, and B, potentially, find a whole new slew of opportunities open to them from an M&A perspective or whatever as a result, which may trade at a bit of a premium. I don't think we're going to get a bubble, and I think you will see, sort of not lower quartile assets, or the ones on the bottom half may struggle to hold valuations. But I think the good assets, I don't see any discount to pre-COVID particularly. If the debt markets continue the way they are.
Right. So, an earlier question we got was on EBITDA multiples, and whether this is going to have a very big impact on what will be the impact on EBITDA multiples, from Mark Attia, the HSB, the French hospital group. I guess EBITDA's fallen, of course.
No, I think what you're seeing, Helia may want to comment from a debt perspective, but certainly from an equity perspective, everybody clearly on the sell side, but also on the buy side, realizes that you need some intelligent pro formaing if you want to buy the asset. Now, ultimately, if you saw what happened, post the financial crisis in 2008, with transaction volume just became very low because sellers of businesses which were resilient and very good wanted broadly the same price, maybe a little bit of a discount, and buyers saw the world very differently. Therefore, there just weren't a lot of deals. I think what you have now with a more increasingly healthy debt market and that amount of dry powder out there is, I don't think you're going to have that buyer's strike in the same way for healthcare businesses. I think it'll be different in other sectors. So if they want to buy businesses, they have to acknowledge that COVID affected a quarter, and you need to pro forma out that quarter. And as I said, the multiples I don't think will be vastly different from the way they were 3 months ago.
I think the key question is what do you, as Headley says, is what's EBITDA? Because I think people would feel it's going to become less about in some ways a little bit less about the multiple and more about what EBITDA do you use. And and I think that's where I think why I'm a bit less convinced things are going to spring back quite so fast on transactions, because you'll need to see a little bit of time where EBITDA normalizes, even if it's for a quarter, so you can actually get a clean view. And also with a lot of the things that Angelika was talking about, which was around government support. So if you're a hospital group and all your revenues, or you're even block paid irrespective of volume to provide for the state, and then that's removed, you need to see what happens after that, or if there are surge demand as there's a catch up of waiting lists because people haven't been able to do cancer surgery. How do you see through that? Or if there is there wage pressure again becoming in the healthcare system, as doctors and nurses who've been on the front line of taking on all this risk say, well, actually now we want price increases or wage increases, and governments feel very unable to resist that now because of everything that all the sacrifices have been made. So I absolutely agree, but I think with what Hedley said, but I just wonder how long is it going to be before as a buyer you can get to a clean EBITDA. I'm not convinced that if July is a good month, you can just say, okay, let's take July and multiply by 12, seasonally adjusted, because I think there's maybe maybe some people will do that, but I think when it gets to it, there'll be a little bit more. You'll need to see a little bit more time to see some clean quarters, or at least one clean quarter where you can feel comfortable that the EBITDA you're doing. I tend to agree. Once you're comfortable with the EBITDA, I think the multiple people are prepared to pay are probably no different to where they were before.
Yes. So yes, there are a lot of headwinds. I mean, there are a lot of uncertainties now, aren't there, with the workforce, aren't there, and these other factors. So what about you, Angelica? What are you seeing on EBITDA multiples? You're not doing any consolidating at the moment, are you? Of course, yeah.
If I'm on the sell side, it's like they won't change. If I'm on the buy side, well, of course I have to change. I think time will tell. It will be a function really on the speed of recovery in some of the businesses, and really how quickly do patients go back. It will depend on country by country. And yeah, there will be the issue as to how do you get to a quote unquote normalized EBITDA, or an EBITDA you feel comfortable with, that you will price off on. Again, if you look at the markets, healthcare, or parts of the healthcare sector, remain quite resilient. So I'm not so sure that multiples would go down that much. And what is sure, given the amount of debt governments across Europe have to borrow to allow for alleviating this crisis, interest rates are not going to go up anytime soon.
Yes, which will help, won't it? Okay, fine. We have another question here from Louis Shakanowski, who runs the largest dentistry group in India. And he wants to know your view on the recovery of dentistry in general and its recovery in India in particular. So who would like to talk about that? Hedley, you presumably had lost time with dentists recently.
Yeah, my knowledge of the Indian dental market isn't complete, but I've rigged around some of the dental chains. I think my assumption, before having got any real data, would be dentistry would be more of a U-shaped recovery, in the sense that most dental work in European countries is routine rather than emergency, and therefore it's obviously easy to put off a dental check for another 6 months if you're feeling unsure about going into the dentist. But actually, a couple who I've spoken to, said that day one, as soon as they reopened, they were pretty much full. So for me, slightly counterintuitive, but we'll know more as more European countries reopen their dental practices over the next month. But from what I've heard anecdotally, they've actually bounced back pretty quickly.